Well, our next guest urges investors to take profits and get defensive. Chris Harvey runs equity strategy for Wells Fargo Securities. I guess you didn't give yourself a nickname because you're back. Good to see you, Chris.
Smart move. It's good to see you too.
But just a warning, don't do it now. No. But what is defensive in this environment, Chris?
Pharmaceuticals defensive, and really what you want to do is you want to look for better balance sheets. You want companies that don't rely on the capital markets to fund themselves. I heard you're going to talk about the banks a little bit later. We are concerned about the banks, but the banking space as a whole, it's fine, but the ability for it to provide capital at a reasonable price, that's where we have to worry about. That's where it starts to cause friction and slow down the economy. We think there's going to be more regulation, so as a result, you have to raise capital, less loan production, and that's going to be a problem.
So here you go, Eli Lilly, and I'm with you on pharmaceuticals, big cap pharma, but just to push back, stock went from 375 all-time high, 310. It's bounced within whisper of an all-time high. These stocks are expensive. I mean, can they continue this run?
They could continue this run, but our price target is 4,200. We're at 41. It's horseshoes and hand grenades. We're pretty close, right? We have a pretty healthy 20 multiple on a 210 number. You're not going to get much more than that. And what we thought is, hey, rates will go down this year. We're going to go into a period where economy is going to slow, growth will be better, and the S&P being a large cap growth index will perform. And you've got that. You can't expect much more at this point in time. The risk reward just doesn't look that great.
So where do you get the beta then?
You don't want beta. You really don't.
You just want to preserve capital.
You want to preserve capital.
That's the environment we're in.
I think that's the environment we're in. I think this is going to be one of the most difficult earnings seasons we've seen in a long time. Because if you don't print perfectly, the Fed's not going to bail you out, the economy's not going to bail you out, and there's going to be a big penalty for a big miss.
So we started the show with what has changed since the banking crisis started. Did you have this view pre-Silicon Valley Bank, or has this evolved since then?
No, this has evolved since then. What we said at the beginning of the year, we expect some sort of economic malaise. We never thought recession. Now we think recession. And so we're getting a lot more defensive here, especially as the market has rallied on the belief that the Fed is done with their tightening cycle.
Dan used the word pesky, so I'll use a baseball metaphor. And guys, stay with me here.
Please.
You could hit a ball about 310 feet in Yankee Stadium in center field, and it's an out. In Boston, you could hit the pesky pole at around 301, 302, and it's a home run. You've had such great trading ranges in this market. It seems to me we're going to have the same great trading ranges. And so I realize you're making a market call.
Right.
But within healthcare, staples, energy, those have been places that are easy to be defensive here. It just seems to me there are places to be investing here, and there are places that are also oversold. And coming out of this, I don't think banks are the place to go run to, but there's no question the sentiment on banks is terrible, and there's banks with great balance sheets that are probably worth owning.
Yeah, if you're a long-term investor, there's a lot of banks that are trading at very, very reasonable valuations and have very good management teams and a more conservative style. But it's going to be tough to exploit that value in the short term. And I agree with you. We're going to be in a range. I think the wheels aren't falling off the cart, but you're at the high end of the range. And could we go higher? Yeah, I guess so. But can you sustain that? Not at a 20 multiple on 210, not for that long. And we're going to, I really do believe we're going to run into a recession. And that's just not great for risk product. And let's not forget, the debt ceiling is coming up. We're going to get some resolution on student loan. And at the end of the day, we don't know if the Fed is done. So still a lot of risks out there.
So your title, Chris, is head of equity strategy.
Yes.
But in order to preserve capital, do you actually recommend going outside of equities?
Listen, I think at the front end of the curve, right, you can make a pretty good rate of return. Overseas, some of the valuations look attractive. What you really want to do is you want really good risk rewards, and you can find that in fixed income and you can find that in equities. You want to be more balanced. So the answer is yes.
I bet he calls himself head of equity strategy.
It's not a nickname.
Like a nickname. Yeah.